October 14th, 2027, 13:17 a.m. Eastern Standard Time. The screens didn't just turn red, they fractured. Across every major exchange, the floor wasn't littered with papers, it was silent, choked by digital smoke that only existed in the cold, blue light reflecting off panic-stricken eyes. How could the price of essential, tangible wheat, the bread that feeds the world, simply vanish? It wasn't a crash, it was an excision. And the terrifying part, the digital ledger showed record holdings, billions of contracts resting safely in servers designed to weather any storm. Yet, on that morning, the actual physical supply chain seized, not because there wasn't enough grain, but because the promise of that grain had evaporated into thin air. The commodities market, the engine room of global physical wealth, had just experienced the perfect digital ghosting. We start here in the echo of the collapse, because this is where the truth begins to decay. We need to understand how a system built on the bedrock of tangible assets, oil, gold, corn, became so utterly reliant on lines of code that when the code betrayed them, the reality followed instantly. Who was holding the contracts that morning, and more importantly, who had the key to erase them? The initial reports spoke of rogue algorithms, a sophisticated hack targeting the global clearinghouses. The noise was deafening and necessary distraction. But the deeper you dug into the architecture of the futures exchange, the less sense the hack theory made. The security protocols were layers deep, the military-grade encryption guarding assets that dictated war and peace. A simple break-in doesn't unbalance the entire agricultural sector. This felt less like a break-in and more like a scheduled demolition. We have to rewind, not years, just 6 months before the Great Digital Vanishing Act. The air in the Chicago trading floor was thick with the scent of stale coffee and high-frequency trading exhaust. It was a place where fortunes were made and lost in the flicker of a server response time measured in microseconds. Our focus narrows onto the periphery, the space just outside the main fray. Here, the transactions were quieter, conducted across encrypted satellite links, dealing not in physical barrels or bushels, but in the right to trade them later. This was the world of synthetic derivatives, the paper empire built upon the physical one. The architects of this shadow system were not the grizzled floor traders of old. They were younger, fueled by complex mathematics and an almost religious belief in perfect market efficiency. They believed that physical reality, silos full of grain, pipelines dripping oil, was messy and slow. The real value, they argued, was in the information about that reality, packaged, sliced, and resold infinitely. One figure, known only by the internal pseudonym the cartographer, began assembling a portfolio unlike any seen before. Not buying wheat futures or selling them, the cartographer was creating an entirely new class of security, layered so many times over that its underlying physical asset was mathematically insignificant. Think of it, a bet on the price of a bet on the price of the actual commodity. Elegant in a deeply unsettling way. The critical moment wasn't the crash, it was the standardization. A decade prior, regulators, eager to appear modern, had pushed for the digitalization and consolidation of collateral requirements across the futures ecosystem. The idea was to reduce counterparty risk. The reality, as we see now, was that they concentrated the entire risk profile into a handful of interconnected central clearing hubs. Every contract, every obligation, ended up in the same digital vaults. The cartographer understood that controlling the mechanism of validation was more powerful than controlling the supply itself. If you control the ledger that says the wheat exists, who needs the actual wheat? The pace quickens. Early indicators were dismissed as market noise, a subtle, almost imperceptible shift in the settlement cycle latency. For 3 weeks, the time taken for large institutional buy orders to register as fully collateralized increased by 12 milliseconds. 12 milliseconds. Enough time for a high-level analyst to notice a slight, rhythmic stutter in the data flow, like a poorly maintained engine struggling to keep pace. This stutter pointed to an aggressive form of rehypothecation on an unimaginable scale. Banks were using the same underlying futures contract as collateral for multiple, simultaneous transactions across different asset classes, a financial Mobius strip. Legally, perhaps technically permitted under obscure clauses, but practically, it meant that the quantity of digital IOUs vastly outweighed the global capacity for physical delivery. The central mystery solidified. If the system was oversold by a factor of 50, meaning 50 digital claims existed for every one physical unit. What would trigger the realization that they couldn't all be settled? The answer arrived not through market volatility, but through regulatory pressure. A sudden, unexpected audit mandate targeting liquidity reserves in sovereign debt markets. The system didn't need to be hacked, it needed to be tested. The Cartographers Network, a web of shell corporations and newly formed, digitally native investment vehicles, moved first. They didn't sell their derivatives, they began aggressively demanding physical settlement for a select portfolio of high-volume agricultural contracts. They weren't looking to profit from the price increase, they were looking for the first point of physical friction. Imagine the scene in the offices of the major clearinghouses as the first wave of physical settlement demands hit. The system, designed for smooth, perpetual digital exchange, choked on the demand for actual dirt-grown corn. The system was programmed to verify the existence of the underlying asset only when a physical delivery notice was initiated. The digital ledger showed trillions in assets. But when the system attempted to trace those assets back to the registered physical custodians, the silos, the farms, the storage tanks, the chain broke. The validation software programmed years ago to trust the derivative contracts as sufficient proof of underlying reality reported success. But the real-world inventory trackers reported emptiness. The gap wasn't in the trading software. The gap was in the interoperability between the financial world and the physical world. The digital contracts were perfectly valid pieces of code. The code stated they were backed by specific physical goods, but nobody had checked if the physical goods were where the code said they were, because the entire structure depended on the assumption of trust. When the first physical settlement failure was flagged, a single shipment of Argentinian soybeans that simply didn't exist at the designated port, the system didn't correct the error. It began a cascade failure based on flawed data integrity. If contract A fails delivery, the collateral backing contract B is instantly suspect. If contract B is suspect, the derivative contract written against its collateral, contract C, becomes worthless. This is where the 317 AM deletion began. It wasn't a hack designed to steal money. It was a system-wide administrative command, triggered by an internal system failure alert, a digital alarm bell that the foundational assumption of the market had been violated. The system, in a panic to prevent total market paralysis due to infinite cascading failures, initiated a clean slate protocol designed for catastrophic server failure, not systemic fraud. The protocol didn't move money. It deleted the liability structure. It zeroed out the trillions in outstanding obligations, effectively declaring that the contracts never existed, thereby protecting the solvency of the clearinghouses themselves. It was a digital suicide pact to save the infrastructure. When the markets opened just a few hours later, the price of wheat was listed as $0, not because it was worthless, but because there was nothing left to trade against. The system had erased the concept of the contract. The cartographer? They had liquidated their small physical holdings days before the purge, profiting from the last few genuine transactions. They walked away holding real assets, while the digital titans were left holding phantom liabilities that had just been wiped from existence. The final, chilling truth is this. The collapse wasn't caused by a failure to secure the digital records. It was caused by the success of a perfectly executed digital abstraction. They built a financial future so efficient, so layered, that it became entirely disconnected from the physical world it was supposed to represent. And when the fragile link to reality snapped, the infrastructure, designed only to preserve itself, chose oblivion over admitting the entire structure was built on an agreed-upon fiction. We didn't lose commodities. We lost our shared belief in the value of a promise.